Welcome to Module 24. In Module 24, we're going to do the first half of Chapter 13. We're going to talk about cost accounting, direct and indirect costs, and period and product costs. Then in the next module, we'll finish up Chapter 13 by talking more about indirect costs, specifically overhead costs. So what we're going to look at here are cost accounting systems. Every manufacturing firm has some sort of cost accounting system in which they accumulate costs for the products which they're making. Included in those cost accounting functions are what we call the value chain. And if you look in your book on page 457, you have a good demonstration there of the value chain and the questions that cost accountants ask in the value chain process. For example, we are looking at things like, is the cost of generating a new idea justified? Gathering costs to see if there's a new product or a new idea that they're going to have. Can they make it worth their while? Can they make a profit on it? Also such things as what's the cost of actually getting the product to the customer? Is it too expensive to produce that product and then deliver it to the customer in an effective way? So those are some ideas of what's going on in the value chain from a cost accounting viewpoint. What we're going to do is look at those costs and those data pieces that they're gathering in the value chain questions and divide them into two groups, what we call direct and indirect costs and period and product costs. So let's talk about period and product costs first and then break those product costs down into direct and indirect. What we're looking at in cost accounting is accumulating all of the pieces of information that we have about a product. In addition to that, we're accumulating costs that have to do with the rest of the operating activities of the firm. Rent that we have to pay on our buildings, insurance, and taxes. So the costs of the product are called product costs. The costs that are not costs of the product, but yet require us to incur because we're running our business, are what we call period costs. Period costs are the costs that you're used to seeing on the income statement. Things like general, selling, and administrative expenses, insurance expense, taxes. Those are period costs. Product costs, on the other hand, are three things that we put into the cost of a product. We take all our costs and we divide them up among various what we call cost objects. In other words, usually our products that we're using in the process that we're producing some sort of physical product. Let's look at the costs that we're looking at that are called direct costs. Raw materials, direct labor, and manufacturing overhead. Those are the product costs that we are going to use over and over and over again in the next few chapters. Period costs, as I said, are those costs that are not going to be included in the cost of the product, but yet they're still important because they're going to be on the income statement. And they're going to be a cost of running the business, not necessarily a cost of the product. So we're going to have raw materials, direct labor, and manufacturing overhead. Now the best way to think about this is to think of raw materials as the things that you can see in a product. For example, if you're looking at your textbook as a product, the raw materials would be the paper, the cardboard, perhaps even the ink that's on the pages. Those are the pieces of the product that you can see that are a substantial cost of that product. Now the direct labor would be the labor that is involved in actually producing the textbook. For example, the people that are cutting the pages, binding it, wrapping it up, getting it ready to go out. Any cost of producing that product that is actually touching the product. Direct labor is somebody that's actually having a physical control of the product at some point. Now there's other labor that we call indirect labor. For example, supervisors' salaries and plant managers' salaries. Those are people who do not actually touch the product or not actually directly involved in producing the product. Although they have a role in the production process, they are not actually the workers on that particular product. So those are your two main costs, and those are what we call direct costs, labor and materials. The manufacturing overhead consists of all the other costs of making a product except materials and labor. Such things as depreciation on your equipment, insurance on your factory building, anything that's an immaterial material cost, for example, a very small cost. Perhaps the glue in this book would be an immaterial cost because it's not going to be very large in comparison to the other costs, but it's a part of the cost of that book. Immaterial labor, little extraneous labor perhaps, that has to do with the cost of the product, but it's not directly related. It's not strong enough a cost to actually be included in the direct labor cost. So we're going to have three different costs that are going to go into a product: materials, labor, and overhead. Now, in the process itself, in the actual production process, think about some of the things that you've seen on TV where they're producing a car. We start out with raw materials, materials that have not been changed in any way, that we just bought from an outside party. If you're thinking about a car, perhaps it's the fiberglass or metal that's going into the body parts of that car. Those raw materials are formed into a piece of the car, and that car, as it's being worked on, is what we call work in process. Work in process is also called WIP, W-I-P. If you hear that term in the jargon term in the real world, that's work in process. That's something you're making that's not complete yet, but you've started working on it. Once you've got it finished, it goes into what we call finished goods inventory. From finished goods, then, we sell the product to our supplier, to our customers, and so we have three different inventory accounts: raw materials, work in process, and finished goods. Now, if you think about the flow of those costs through the accounting system, everything starts out in raw materials. It moves from raw materials to work in process. Then it moves, as we're working on it and finish it, over to finished goods. As we sell it to our customers, it moves into cost of goods sold. So the diagram you see there in front of you is a depiction of that flow of costs from raw materials to WIP to finished goods and finally to cost of goods sold. Remember that diagram, because if you can picture that diagram, it will answer a lot of your questions that have to do with costing of products. And we're going to go through the next couple of modules talking about costing of products, looking at direct and indirect costs. And if you can kind of relate all of this to a car production facility or some other production facility that you're familiar with, it'll make your job a lot easier to kind of figure out where the costs are going. So let's use some examples at the end of this chapter to kind of get a handle on what we've been talking about. Let's look at problem 13.3, which is in your textbook at the top of page 481. What you have here is a cost group, in other words, a number of different costs for a particular product, and you're to decide whether they're direct or indirect, period costs, and fixed or variable. Now, you're going to have to remember that we talked about fixed or variable costs in our previous modules. Fixed costs don't change regardless of our activity. Variable costs change in relationship to our activity. The more we do, the more our variable costs will be. So let's go through some of these and talk about the pieces that go in here. On the first one, wages of our assembly line workers are a direct labor cost. That's a direct cost of the product. And that's a variable cost because the more products we make, the more our wages are going to be. Depreciation on our plant equipment, it's not a direct cost because it's not labor or materials, so it's an indirect cost. And depreciation, unless we're using units of production, is a fixed cost. And depreciation goes on regardless of how many products we make. Glue and thread, these are the examples of those little items that show up in a product, but they're not significant enough to be included in direct materials, so we stick them in as an indirect cost, called indirect materials, and they're variable. The more we make, the more glue we use, the more thread we use. Shipping costs they put in there to kind of confuse you. Shipping costs actually occur after the product is already made, so it's not a cost of making the product. Therefore, it's a period cost. The more products we do make, the more our shipping costs would be, though, so that would be a variable period cost. Raw materials handling costs. Raw materials, again, will be an indirect cost because we're not actually including that in the cost of the product. It's not materials and labor. It's just the people that are moving those raw materials around. But the more products we make, the more we have to handle the materials, so it's variable. The public relation manager's salary. Doesn't have anything to do with the cost of the product. It's not direct materials or direct labor, so it's a period cost. And the manager's salary will continue at the same level regardless of how many products we make, so it's a fixed cost. Production run setup costs. Production run setup costs are an indirect cost. They're not materials or labor, but they are variable. The more products we make, the more we have to do setups of the machinery to make those products. Plant utilities. We talked about utilities earlier. Utilities have a variable and a fixed component. Usually there's a fixed component of actually providing the service, and then there's a variable component of the amount of electricity used. So you would have to check both fixed and variable on that. And since these utilities relate to the manufacture of the product, they're a cost of the product, but since they're not materials or labor, they're an indirect cost. Electricity costs for the retail stores. This is not a cost of making the product. If it's a retail store, then it's a period cost, and again, it would be fixed or variable if it's electricity. And finally, R&D expense. R&D expenses are period expenses. They have nothing to do with the actual production of the product. R&D can have both fixed and variable components. Usually the salaries of your researchers are fixed, but the more research they do, the more variable costs you have for test tubes and testing equipment and stuff like that. So it can have both fixed and variable costs. So that particular exercise was to get you to thinking about the various costs that are involved in running a company, which ones are period costs, which ones are product costs. If they're product costs, they're direct materials, direct labor, or any other cost associated with making the product. And then finally breaking it down into the fixed and variable components. The last exercise I wanted to look at in this section is exercise 6, which is near the top of page 482 of your textbook. And this, I think, relates to something that you can kind of picture. Campus Carriers manufactures backpacks that are sold to students for use as book bags. They ask you to identify a specific item in the company's manufacturing, selling, or administrative process for which the cost will be classified as, and they give you A through G categories. For example, raw materials. Now think about a backpack. The raw materials would be the material that's actually used to construct the backpack, perhaps nylon or leather, the zippers that are used to close the bag, and perhaps even the straps that you use to carry the bag. The direct labor would be the people who are actually sewing the pieces together or attaching the straps. Those would be direct labor. Variable manufacturing would be such things as electricity for the machines. The more you sew, the more electricity you're going to use. Fixed overhead would be your depreciation on your sewing machines. Fixed administrative expense would probably be the president's salary, the PR person's salary, the president's secretary's salary. Those would all be fixed administrative expenses. A fixed indirect selling expense would be perhaps the sales manager's salary. It's fixed, it doesn't change regardless of the activity, but it's not really a cost of the product. It's an indirect cost. Variable selling expenses would probably be sales commissions. The more they sell, the more the commissions are going to be. So this exercise 6 was to get you to think about an actual product and to identify the types of costs that go into that product and make some relationship between direct and indirect, period, and product costs. You may want to repeat that with another product you can think about, something you're familiar with, perhaps a microwave oven or a television, and kind of think about the ways those costs are used. In the next module, we're going to continue with Chapter 13, and we're going to talk about overhead and how we allocate fixed and variable overhead.